Let me start with something most people probably don't want to hear. The tax holiday era is over. During and after COVID, we all know that ATO enforcement softened. The focus was stimulus, survivor, and keeping businesses alive. Compliance still existed, but it wasn't aggressive. Now, we're in a completely different phase. The tax environment has tightened, audits are increasing, data matching is stronger, and ATO is actively reviewing structures that were once considered normal. And one of the biggest focus areas right now is family trust. So today, I want to walk you through the reality clearly and practically, because having a family trust does not automatically mean you are saving tax anymore. Hey, welcome back. I'm Molly, a certified tax accountant and founder of Above Advisory, where I help business owners and investors make smarter tax decisions, stay compliant, and building long-term wealth. If you want a straightforward tax strategies without fluff, hit that subscribe button to this channel. Now, let's discuss a myth directly. You might have heard this before, where your friends or family members saying, "Oh, just go and set up a family trust and distribute your income to your kids. You'll save lots of tax that way." That used to be more common, especially when income could be split more freely between family members in lower tax brackets. But here's the reality in today's environment. A trust does not reduce your tax by default. It's just a structure. The tax outcome depends entirely on how it's used. If it's used properly, it can still be flexible within the rules, asset protection where appropriate, succession planning benefits, and long-term structuring advantages. But if it's used mainly to shift income around real substance, that's where the risk begins. Now, let me explain to you why trusts are under closer attention by the ATO. Here are 6 main focus areas ATO is paying attention to. The first one is income splitting arrangements. Income splitting is when income earned in one place is distributed across multiple family members or entities to reduce the overall tax bill. For example, a business earns $400,000. Instead of one person declaring it all, the income flows through the trust and is distributed to spouse, adult children, or possibly a company. Income splitting itself isn't automatically wrong. It becomes risky when the recipient didn't receive the actual distribution and it was only on paper and the tax return. So when the structure lacks commercial purpose or when the arrangements exist mainly for tax reduction, ATO can then decide the distributions are not genuine and disregard the entire tax distribution overall. It is important to remember that having family trust for flexible distributions among family members and asset protection is allowed, but artificial income shifting is not anymore. Second, distributions where the beneficiary doesn't actually benefit, including Section 100A risk. Like I said earlier, sometimes trust income is distributed on paper, but the beneficiary doesn't truly receive or control the benefit. For example, money might be transferred back to the parents, pooled and controlled by one person, or never actually even assessed by the named beneficiary. The tax system looks at economic reality, not just the paperwork. This is where Section 100A becomes very important. Section 100A is an anti-avoidance rule that can apply if the trust income is distributed to someone and another person actually benefits from it, and the arrangement was entered mainly for tax reasons. If Section 100A applies, the distribution can be totally ignored and the income may be taxed at the highest marginal tax rate. That is quite a serious exposure. The key question isn't about who is the named beneficiary, it's whether there is a genuine entitlement and a real commercial or family purpose behind the trust distribution arrangement. Third, professionals and personal services income, or PSI. This is my favorite topic. This affects consultants, contractors, freelancers, medical professionals, legal professionals, creators, and specialists. If you want a full list of personal services income, and if your business might be classified as PSI, I'll leave a link below for you. Basically, if most of your income earns from your personal efforts, skills, or reputation, the PSI rules may apply. PSI rule simply means your income is mostly tied to your personal skill set and you're not operating like a business. So If your income category falls under PSI rules, it means even if your income flows through a company or trust, your income tax bill will still remain as an individual marginal tax rate. You'll not be able to reduce your tax by simply changing the structure where your income is directed to. If PSI rules apply, income may still be attributed back to individual. This means if your income is mainly tied to your personal skill set, you should review your business structure every year and assess the PSI rules and tests. Number 4, circular cash flow arrangements. This occurs when money moves in loops between related entities. For example, trust distribute to a company, then a company loans money back to the trust, or funds circulate repeatedly between entities. If the main purpose is to defer tax, manipulate timing, or artificially manage profit, it may attract scrutiny. I often see this happen when business owners don't even realize it has occurred. It could be due to they received wrong or incorrect advice, or simply because they did not pay attention on how the trust distributions work among their business group. ATO now uses very advanced data analytics to trace these patterns. Money movement must have a clear business purpose and not just a tax effect. Number 5, poor documentation and governance. Many trust problems aren't caused by complex tax law. They are caused by poor administration. Common issues include no trustee resolution before 30 June, distributions not properly documented, or trust deeds not reviewed for many years, or missing records, or informal family arrangements. In tax law, timing and documentation are very important. If distributions are not properly resolved and recorded, they may not stand. Trusts require governance, not casual arrangements. And 6, aggressive tax minimization strategies. There is a clear difference between strategic planning and aggressive restructuring. Aggressive strategies may involve artificially low distributions to high-income earners, complex layering of entities without real purpose, recategorizing income purely to change its tax treatments, or structures designed primarily to avoid tax rather than to operate a business. So ATO applies substance over principles. If an arrangement wouldn't exist without tax benefit, that increases the risk. Now, when you look at all 6 focus areas, one principle should stand out to you: substance over structure. The ATO and regulators are not saying trusts are illegal. They're saying structures must reflect real economic activity. Income must follow genuine entitlement, and documentation must be proper. And also your arrangements must have commercial logic. That's the environment we are currently operating now. So what should you do? If you already have a family trust, you should review your distributions regularly, ensure trust resolutions are properly documented and documented all the time. Confirm beneficiaries are genuinely benefiting from the distributions. Check whether PSI rules could apply to you or your business. Revisit your trust deed periodically, and seek professional advice before making aggressive changes. If you're thinking about setting a family trust up purely for tax reasons, you should reconsider and see if there are any other benefits you will receive from the structure first. We've moved from flexible post-COVID environment into a structured environment era. The ATO is actively reviewing trust arrangements, and having a family trust today does not automatically mean you will pay less tax. So if someone tells you, just set up a family trust and you'll save tax, just remember that's a very outdated advice. In 2026 and beyond, compliance, documentation, substance, and governance matter more than ever. If you found this helpful, like and subscribe, and let me know in the comments below if you're already doing these important checks if you currently have a family trust set up. I'll see you in the next video. Bye for now.